Hello, everyone, and welcome to the Financial Advisors Want to Know podcast. I'm Catherine Tindall, a CPA with Dominion. We're a specialty tax and accounting firm that works for financial advisors as their tax expertise. And on today's episode, I have with me Scott Leek. He is a 25-year veteran in financial services. He's a CFP and a CEPA. He is a senior consultant at FP Transitions, the industry's leading provider of valuation, succession planning, and M&A consulting. So thank you for joining me today, Scott.
Thank you. Pleasure to be here.
Yeah, and this is something that's, so today we're going to be talking about valuations and see where the conversation goes, but it's an especially timely topic because a lot of clients of ours have been talking to us about this. I had somebody message me a day or two ago saying, oh, I was told that I'd get a 2.2 multiple, but now, somebody else says I could get a 4.0 multiple. And, what do you think, Catherine? And I'm like, well, it sounds like you actually just need to dig into your world, Scott.
Yeah.
So, for advisors who are thinking about this and, they get those like, oh, these jaw-dropping multiple numbers. What's your advice for where they actually need to start when they're thinking about the value of their practice or, getting interested in that?
Getting a formal valuation done is a really good place to start. And why someone wants a valuation drives what type of valuation methodology makes the most sense. So there's different ways to do a valuation. Now, if we were talking a different industry, if we were talking about like manufacturing, you might want to use an asset-based approach to valuation because you need to measure the value of all these hard assets, the factory, the machines, the widgets it produces. But really what advisors are selling when they sell their business is the goodwill between them and their clients. It's this almost intangible thing. And so you need to take a different approach to valuation. Now, if someone's just looking to kind of benchmark their business, have an idea of what they're worth, or actually sell it to a third party, then usually a fair market approach to valuation is sufficient. Now, we do 1,000 valuations a year. About 700 of those are taking a fair market value approach. For someone with a book of business or kind of a small business with a handful of employees, that's usually pretty sufficient. We do 100 plus M&A transactions a year. So we've got a really good idea of what market comps are, and we can compare those to the overall methodology that we've been doing for, over 15 years. We've done now 16,000 valuations in our company's history. So we've got ample data in our database that really helps us have informed decisions on that. But if someone wants to do a valuation because they're planning to do internal succession and sell to someone inside the business, if they've got a junior advisor or somebody that they're kind of bringing up and they want to gradually sell and transition the business over a longer period of time, because the business is going to continue to exist, a different methodology makes a little bit more sense. So usually we say, let's take an income-based approach to valuation, do a discounted cash flow analysis. And in doing so, we can also then calculate what is the minority stake of this business worth. So let's just say you got a business that's worth $10 million and you want to sell 10% of it to your second generation, your G2. That's worth less than $1 million. It's an illiquid position and it's a non-controlling interest. So generally speaking, you discount it. And so a fair market approach to valuation isn't going to properly account for that. So again, it all comes down to why do you want the valuation done, which is going to help inform what type of methodology to use.
Yeah, that's great. And I think for a lot of advisors, something that I always consider and is part of the questions that we have when people kind of come onto the firm and getting a sense of where they're trying to grow into is, okay, have you done a valuation recently? Like, I know you're not trying to sell the business, but if you're going to benchmark like your actual growth and the success of different things you're implementing, and this comes more into like exit planning kind of work of just, how sellable is this asset? It's something that a lot of the advisors I talk to, it's not really something they've invested time into yet, which is kind of funny to me because it's like, well, isn't that the whole purpose of in some ways, like it's the whole purpose of running the firm. It's like, even if you're not going to sell it,
yes, that you should run it like you're going to.
Yeah, right. Because a business that's good to sell is a business that's good to run.
Yes.
So I'd love to hear some of your thoughts around the exit planning process for firms where, I get these people where they come in and they think they're going to get a juicy multiple. And it's like, okay, well, actually you have to do exit planning first and figure, get a baseline of what's your current valuation, do the exit planning, see if we can improve that number, whether or not you're going to sell. I'd love to hear kind of what your experience has been with advisors that are kind of in that spot.
Yeah, that's one of the main things we do here at FP Transitions. So, to put it succinctly, we do one of three things, or a combination of three things for our clients. We help them identify, grow, and realize the equity value of their business. That's it. And this is the only industry we work in. So valuation's obviously an easy way to help identify the value of the business, but then a lot of our clients have us on kind of an annual retainer, if you will, to do evaluation every single year and benchmark them against a peer group. And so because we're doing so many evaluations, we've got so much data that provides really great benchmarking, and we'll show them, how do you compare on 50 different KPIs against other firms that are the same size as you? And not just, the custodians do some pretty good work. I can think of a mutual fund company or two that does good work on benchmarking, but theirs is static. It's based on surveys, and it's always based on AUM. Well, AUM isn't necessarily perfectly correlated to value. And so there's other metrics that we put in place, and we've got a little bit more complicated way of cohorting people to really make sure they're in a really tight comparison group. Because sometimes if you're at 505 million, you're put in the same group as 500 million to $1 billion. Well, a $500 million firm and a $1 billion firm have a lot of differences in many cases. So when we do our benchmarking, what our real goal is to figure out, where are they in various, top and bottom quartiles along all these different metrics, whether it's revenue based or expense based or based on client demographics. And then we can help identify, like, if we were to pick 3 or 4 KPIs we really wanted to focus on in the next year, what targets would we want to set, and how would those help boost the value the most over the next year? And so that's really, if for someone who wants to think about with the end in mind, which, last I checked, CFP stood for Certified Financial Planner, not Certified Financial Procrastinator. So, you want to start planning these things ahead of time, just like you do for your clients.
Yeah, absolutely. Because for most advisors, right, this is the biggest asset you have.
Yep.
By a lot. And so really investing the time into optimizing that makes a huge difference. And especially on the tax side, knowing beforehand, okay, this is what we're walking into. This is what we're trying to build. Maybe we're going to have an exit at some point. Knowing what's going on generally on that piece of it allows on the tax planning side for us to get ahead of, okay, well, how do you want to structure deal terms in order to get the best out of this? Because are you selling this to an outside party? Are you selling this to an internal successor? Because we can do very different things if you're going to have a closer relationship there. So I'd love to hear a little bit about what you've been seeing on like the deal term sides and some of those pieces for the M&A work you guys have been doing. Hey there, Catherine here. Thanks for listening to the conversation. Just wanted to explain a little more about what we do. So I'm a CPA here with Dominion. We're a tax firm that works specifically for financial advisors as they're growing and scaling their practices to help them avoid tax waste, make the right calls, and grow practices that they love. So if you're interested in saving more, you can DM me on LinkedIn with the word guide, and I'll send you over our guide for financial advisors to scale tax efficiently. All my top tips to unlock 6-figure savings. Thanks, and keep enjoying the show.
Yeah. So when you look at an external deal, when someone's partnering with, let's say, a larger company, generally speaking, you're selling or merging with someone that's at least your size, if not twice your size or larger. And so what we're typically seeing in the last few years has been an increase in the down payment. The down payment averages are probably in the 40 to 50% range right now, with the rest of it being structured on maybe a 3 to 5 year note. And the tax allocation's been increasing more and more towards long-term capital gains in a lot of these cases. So for someone who is, kind of selling and walking away, we're looking at probably somewhere around 92% allocated to the goodwill, which is going to get taxed at the long-term capital gains rates. And then the remaining, 8 to 10% is going to be on a restrictive covenant, because they need to sign something that says they're not going to go set up another RIA across the street and then go poach the same clients they just sold. So a restrictive covenant, that's going to have to be taxed at ordinary income rates. And then they're going to have usually some type of consulting agreement that says, I'm going to help transition the clients over the next year. We're actually seeing probably closer to 70% of our deals now are what we call a sell and stay, where the advisor is really truly looking for continued growth, and they've just maybe hit a plateau, and They want to figure out, how do I scale up more quickly? How do I get the growth that I used to have? Because they probably just hit some capacity restraints, and you've got a lot of work to do if you want to bring in more people. It's really tough out there finding new talent. And so we're seeing this kind of the sell and stay concept of, I'm going to sell the business. I'm going to take some of the BS of running the business off my plate and let someone else worry about that. So I can go back to doing what I do best, which is being a wealth manager for my clients. And in those cases, you can see the goodwill creep up even higher to maybe 95, 97%, because they're not having that consulting agreement portion anymore. It's more or less an employment agreement instead.
Yeah. Yeah. And that's funny because like I just was talking online to somebody who was a solo RIA, and then she switched and went back into being a W-2, and I think must have rolled her practice up.
Yep.
And I think that was the maneuver, because she was just like, it was too good of a deal and didn't want the hassle of having to run everything herself.
Well, and another advantage of doing that too, Catherine, is that oftentimes it's not even an all cash transaction when you're doing that. When you find that good partner, you might do an equity swap, which usually is tax deferred, at least for that portion of it. And presumably you're picking a firm that's growing faster than you are. So it's like, okay, I'm going to sell part of this business that I may be growing at 9, 10% a year, but now I'm getting an equity stake in a company that's growing at 20% a year, and I have more capacity. So I'm going to help grow. And I've got these growth kickers in my terms and conditions. So for a lot of people, like, they have this notion of, well, I'm going to make the most money if I own this business as long as possible to the last minute. And that's not necessarily true.
Yeah. And two, it kind of reminds me of the, there's an analogy that's always used of like, do you want to have the whole pie and have it be, this big, or would you rather have a piece of the pie that's that big? And, I think for a lot of advisors that I talk to, there's this kind of, they initially go independent because they're just like, hate the restrictions and hate different things about where they were before.
Yeah.
And then they get to a certain point where they're like, actually, I can see why a lot of this was like this. This is really messy to run this thing. And if I actually want to grow, like, I just need to be much better capitalized. And so if I can partially do one of those transactions, that's how I'm actually going to get to where I want to be, from an operations perspective, and then from like a growth perspective. So that's all.
Well,
great.
And I think for a lot of advisors that go independent that maybe are coming from the wirehouse environment, there's still something very valid about, I don't want to work for the man anymore. I want to be able to sell, whatever I think is most appropriate to my clients, not just the products that my company sells, and just be a fiduciary, do what's best for the client, put the client first. You don't have to own your own business outright in order to do that. And I think a lot of times people just kind of make the assumption that I need to go from A to B. They don't know that option C is out there when they're at the wirehouse.
Yeah, absolutely. That's definitely true. That's something I've encountered a lot. So for people who are maybe like on the smaller side, they're running their practices. They're like, okay, I need to get a valuation. I need to be thinking about exit planning. Like, what's a common progression of like when you recommend size-wise for people to start that process?
I don't really think of it in terms of size. I think of it more in terms of time frame. So, a lot of advisors have probably had a prospect walk in their office at age 60 and say, can you help me plan for my retirement? And the answer is, yeah, I could help you more if you came in 10 years ago, but yeah, I can help you. But the longer you wait to do that planning, for the client of an advisor, okay, well, there's only so much we can save a year. There's only so much spending we can cut a year. So options get limited, and you certainly have certain things forced on you that maybe you just have to postpone retirement a little bit longer. And it's the same thing for advisors. Like there's about 8 ways that any small business owner in this country can exit their business, from attrition all the way to IPO. And there's tons of choices in between. But the longer you wait, the less options you have. So I generally say, no later than like age 50, should you start planning for your exit. And if you're planning on doing it internally, you need a good 10, 20 years to do that. I had a client call me one time who I'd been working with for a while. Her name was Carol. And Carol called me up one day. She's like, Scott, I'm finally ready to do succession planning. And I said, okay, when do you want to have, everything, you have sold everything, you own 0% of the company. When do you want to have that all done? And she said, well, before I start taking RMDs. And I said, aren't you 70? And she said, yeah. And I said, well, last time we valued your business, it was $6 million. You think your 35-year-old G2 can afford to pay you $6 million the next 2.5 years? Like we have to adjust this plan. Like we can make it work, but you waited too long to start this process. So 10 to 20 years before they plan to be completely done is when they should start internal succession plans. But I always say too, like it's never too early to start exit planning. Exit planning is business planning. If you can run your business and it can run without you, you have built a successful business that can be sold at any time. And at that point in time, when you've got it there, you can keep growing it or you can move towards your exit. Either way, you're in great shape.
Yeah, absolutely. And that's funny that anecdote you give, because I had a similar one. And basically what ended up happening with the client, she was looking for more of like a sweetheart thing for her G2. So she didn't really care, too much on the valuation side and everything. But I think for a lot of people, they don't realize that's like math that they just don't realize is, oh, they're not actually going to be able to afford this. like if I actually want to have this exit, and then with the current interest rate environment and banking environment, it's like, yeah, I don't think we'll be able to get this financed. Like this is not, on the timeline that they want, which is, even for some of them, it's like, oh yeah, over a 6-year window or over a, like a 10-year window. It's like, even when you do the math out like that, it's still not going to work well.
I actually have a question for you on this. So we get asked a lot, and I've got my answer. I'm curious how you would answer this. Somebody might say, well, what if I just gifted some of the shares to the G2, or I do it at 0% interest rate instead of doing it the AFR? What maybe gift tax implications could that have?
Oh, that's something that I would want to research it and look at tax court precedents before giving an answer on it. But my initial instinct, just in general, how things tend to work with the tax code is that they're just going to say, well, it's not really a gift, right? Because this is a business asset. And unless the person's like a like you would have to make the argument that it really is a gift and not just a sale, because if it's a business asset and it's a business transaction, you've been paying the person compensation. Like, is it really a gift? I would expect that
sweat equity.
Like I would expect that they would come back and challenge that, because it's like the economic substance of it doesn't really make sense. Like it's not really something that you do. But I guess it probably depends on how they're structuring it, like what the relationship is. And then also I would want to make sure that we look at, like, have there been any tax court cases that have referenced this? Like, what does the IRC say? And then you don't have to get too uppity, I think, on, some of the, like, IRS interpretations of things have different levels of authority. And so depending on the size of the transaction, I would just be more concerned around, like, what's the tax court precedence for this? And then if you do have the IRS come and challenge you, like, how much money's on the table? Do we actually want to challenge this and accelerate it? But it's one of those things where I think the more, and I was talking to an advisor a couple of days ago who's buying out a practice from somebody else, and she's doing it the middle of next year. And I'm like, perfect. Let me know when you get closer to some deal terms. We'll run some projections and figure out what's going to make sense for the seller, what's going to make sense for you. And can you restructure some of these deal terms to make it more tax advantageous so that it's going to be less cash out of pocket for you as the buyer? Or we can just kind of negotiate that, because if we can structure this in a way that's going to make it more, you're not creating tax waste from the transaction, then it's just going to be less cash out the door for everybody. So, but and I think that's why time,
Yeah. And I think that goes back to the one of the first examples you gave of, like, someone who's told on one hand, 2.2, 2.4 multiple, and on the other hand, we're being told 4. Well, if we want to get creative with deal terms, we can make either one of those scenarios happen.
Yeah.
So the valuation is, it's highly contingent on what the deal terms are. So, yet another reason to get a formal valuation done and have someone on your side that knows how to do those negotiations. Because, if you want to get 4 times revenue, like, maybe we can do it, but you might be looking at a 20-year earnout rather than a 5.
Oh yeah. That's great. So for people who are interested in getting connected with you, Scott, and then your team over at FP Transitions, what's the best way for them to learn more about the work you guys do?
Well, certainly, if you want to try to find me on LinkedIn, you can do that. fptransitions.com is our website. There's tons of ways to, click on things and schedule a meeting with someone like me or someone on my team. Or if somebody wants to email me directly, scott.leak@fptransitions.com works as well.
Yeah, that's great. So I'll post those nearby wherever you're encountering this content, dear listener. Any final thoughts, Scott, before we close out?
The one thing we didn't touch on today that I think is really important, and it's something I'm evangelical about, I really want everyone to make sure that they have a continuity plan in place, just something that says in the event of my death or disability, what's going to happen to my clients, my staff, my estate. It's quick, it's easy, it's cheap, it's revocable. It is the beneficiary form of what you said, Catherine, is most likely the largest asset these people own. So fill out the beneficiary form for this asset, please.
Oh yeah, that is excellent advice. Honestly, that's something where I don't have it in my initial intake assessment, and I need to add that. So we're going to start asking everybody that, because
Awesome.
that is a core, and a lot of people don't even realize that they need to do that. Great. Well, thank you so much for joining me today, Scott. I really
Thank
appreciate
you.
it.
My pleasure.
Yeah, and hopefully we'll see you on another episode soon for some other fun topic.
I'd love
The
it.
clients have been asking me this, Scott. Let's talk about it. So thank you
Anytime.
everybody for listening. And if you're interested in the work that we do here at Dominion for advisors with their tax strategy, you can get in touch with us with one of the links nearby. And thanks for joining in on the show. And if you have any thoughts or comments, I'd love to hear from you about what you thought about this episode and future episodes that we have. So thanks again for joining me, Scott. And this was Financial Advisors Want to Know.